Have you ever imagined how life will feel when you quit your job? When you no longer have to depend on your 9-to-5 for survival? When you start making the real money, the cool cash, without all of those stress that you are going through right now? Alright, this is a kind of how my life looked like 9 years ago. Working at the building site, going through hell, battling with all the body pains from yesterday, but I will still have to show up the next day, because I would go broke if I don't keep putting in the work. I wake up with great affirmations, feeling like a hustler, but this work felt like hell. My alarm would wake me up very early in the morning, and by the time I check my phone, I will be staring at ridiculous amounts of profits on my demo trading account from the trades that I took a night before. Then I said to myself, bro, I can be making more money in my sleep than I do when I work endlessly. And that shifted my mindset, and I took Forex trading more serious, finally quit my job, and began making hundreds of thousands of dollars every month. Many of you can relate to my story because you are going through almost the same thing right now. But hey, you finally found the right video that will guide your steps. In this video, I will show you exactly what I did to break free from my regular 9-to-5 job. And at the end of this video, you will also get the blueprint that you will use to quit your job and begin making life-changing profits from your trading account, including the simple trading strategies that I use to make profits from the market during my days as a 9-to-5 worker. Before I finally quit my job and began living the life of freedom, the life of my dreams. But before we get into all of that, do well to like this video to help other traders like you to find it, quit their jobs and finally move into the life of profits and freedom. So my tribe soldiers, let's get down into this business. Now, before we start, let's first understand what Forex trading is all about, the concepts, how it works, and then the strategies we can use to trade them and make easy money from the market. Forex is a mashup of foreign exchange, and it is commonly used to refer to the foreign exchange market, the largest financial market in the world. Now, picture a massive marketplace, trading across all the corners of the globe, but rather than having goods on sale, this market trades in global currencies of different countries across the globe. The Forex market, or the foreign exchange market, is one of the most widely traded markets in the world, with daily trading volume of over $6 trillion. Unlike the stock market, the Forex market is open 24 hours a day, from 5 p.m. Sunday to 5 p.m. Friday Eastern Time. So you might be wondering, where exactly is the Forex market based? Well, it's actually everywhere. Forex is a decentralized market with no single central authority or exchange that governs it all. Instead, it is made up of a network of banks, brokers, institutions, retailers like me and you, and even governments who trade currency with each other. Now, let's go through some of the key concepts you must know about Forex. First, the currency abbreviations. Each currency is represented by a 3-letter code called an ISO code. Here are some of the main currencies traded. USD is the US dollar, also known as simply the dollar. AUD is the Australian dollar, also known as the Aussie. NZD is the New Zealand dollar, also known as the Kiwi. EUR is the euro. CAD is the Canadian dollar, also known as the CAD. GBP is the British pound, simply known as the pound. JPY is the Japanese yen, also known as simply the yen. CHF is the Swiss franc, also known as the Swiss. Now, what is a currency pair? In Forex, currencies are traded in pairs, because when you trade Forex, you are buying one currency while selling another at the same time. Let's use the euro-dollar currency pair for example. The first currency in a pair is called the base currency, and the second currency is the quote currency. Let's say you get a quote of euro-dollar as 1.12852. This means for every 1 euro, you get 1.12852 of the US dollars. There is always an invisible one beside the base currency on the left. So here is what happens when you actually trade currency pairs. When you buy a currency pair like the euro dollar, or when you go long on the euro dollar, you are expecting the euro to appreciate, while the dollar depreciates. When you sell a currency pair like the euro dollar, or when you go short on the euro dollar, you are expecting the euro to depreciate, while the dollar appreciates. Next we have the major currency pairs. These are the major currency pairs. The major currency pairs are those trading pairs that include the US dollar. As the US is the world's largest economy, and since you are in your early stage of trading, I highly recommend you focus on trading the major currency pairs, as they are the most liquid. And when I say liquid, it means that you can get in and out of positions easily and fast with tighter spreads. Next is pips. What is a pip? In the Forex market, exchange rate changes are measured in pips. A pip stands for a percentage in point or a price interest point. This is a standard measurement for the smallest whole unit price move that an exchange rate can make. For instance, if the Australian dollar is sitting at 0.6754 and its value gained by 1 pip, it would move to 0.6755. Most currencies are written to the 4th decimal place, like the one I just used as example, with the 4th decimal place representing 1 pip. However, some currency pairs decided to be special, such as the yen cross pairs. The Japanese yen is often quoted to 2 decimal places. So a 1 pip gain would be 46.4, rising to 46.5. There is also a pipit, which is a fractional pip. That is a 1/10 of a pip, and is represented by the 5th decimal place. But before we continue to the next concepts, make sure you have subscribed to this channel if you are new here, and join our Telegram community, where I share all my live trades and my trading results. You will see how I trade in real time, and I would like to hear from you. Feel free to drop your questions in the comments section. Now, the next concept is called the lot size. In Forex, trade positions are measured in lot sizes. A standard lot represents 100,000 units of the base currency. A mini lot is 1/10 of the size of a standard lot size and represents 10,000 units of the base currency. A micro lot is 1,000 units of the base currency. And a nano lot is 100 units of the base currency. Next is bid, ask, and spread. Each transaction in the market has a bid and an ask price. These 2 prices form the basis for trading in the Forex market. When you are looking to buy an asset in the Forex market, you will pay the ask price for the base currency. When you are looking to sell an asset in the Forex market, you will sell at the bid price. The difference between the bid and the ask price is called the spread. In essence, the bid-ask spread is the difference between the price a dealer will buy a currency and what they will sell it for. The spread covers the dealer's profit and the cost of the transaction. It is simply the cost you pay to enter the market. It is important to note that different brokers can offer different spreads, or they may offer variable spreads that can change based on market conditions. Next we have brokers and leverage. Now listen, an individual trading the Forex market is called a retail trader. And the retail traders, like me and you, requires a broker to access and trade the Forex market. Brokers provide leverage, which is you using borrowed capital from the broker to trade much larger positions than you could otherwise take with the amount of money in your account. Imagine leverage like using a financial lever. And with this lever, even with your minimum strength, you can lift heavy loads with less effort. Unlike a lever magnifies your physical strength, financial leverage magnifies your trading power. Essentially, leverage turns up the volume on trades. However, with the potential for more profit comes the potential for more loss. It is important to keep in mind that leverage can act as a double-edged sword, and leverage offerings vary from broker to broker, and they are usually expressed in a ratio such as 1:50, 1:100, or 1:500. Usually, traders will be required to deposit a margin of the trade to act as collateral for the leveraged position. Next is liquidity. This concept is very popular amongst traders. Now, visualize a large global marketplace where many players are trading. Each transaction barely makes a ripple on the surface, like dropping a tiny stone into the ocean. And because of the market's vast size, people can quickly enter in and out of trades without causing much disruption to the exchange rate. To be simply put, a liquid market is a financial market where lots of trades occur, and it's easy for traders to buy and sell. Next, we have the market volatility. The market volatility have two states. We have the high volatility and the low volatility. High volatility means that prices are changing rapidly and by significant amounts, like a crazy roller coaster ride with sudden drops and steep climbs. Notice the drastic and wide swings of price, which signals high volatility and means that there is more risk for your trades and also more profits for you. Now, during the times of low volatility, the market is always calm with smaller exchange rate fluctuations and price changes. This low market volatility is like leisurely riding on a scenic railway. Notice the small swings of price, which signals low volatility, and that means that there is less risk for your trade, but also less profits. Now, there are many factors that can cause market volatility to increase or decrease. Things like inflation, market demand, foreign policy announcements, political and economic conditions, economic data releases, central bank decisions, natural disasters or crisis, changes in interest rates. With all these factors at play, it can cause many swings in price. Now, concentrating on exchange rate fluctuations is one of the most common ways for individuals to make money trading in the Forex market. And now that we have known all the common concepts of Forex trading, the question is, how do we make money from the Forex market and finally quit our job to begin to live a life of freedom and joy? The answer is technical analysis. Technical analysis is the act of studying historical price movements and data in order to identify similar patterns that have the possibility of repeating themselves in the future. The idea here is that history loves to repeat itself. Think of technical analysis like a detective, hunting down clues to uncover how an individual acted in the past, in order to try and predict how they will act again in the future. There are many technical analysis strategies in the market, and I have taught a lot of them in my previous videos, but there is a special strategy amongst them that I always refer to beginners to start making money with, and that is the trendline strategy. So literally, all you want to see is a price movement like this on the chart. A higher high, a higher low and another higher high, and then you draw a line on it. This line is called a trend line. The trend line helps us to take advantage of the market trend movements. So we understand that since the market made this move, it signals a potential trend change, and when price returns to the line, we will be expecting the price to bounce up from the line and start moving up in our target direction. It is very simple. Now, let's see another example of this. So here we have the market formed a trend movement. Here we have the higher high, the higher low and another higher high. So we can draw our trend line on it. And after that, the market returned to the line and began to move in our target direction. This strategy is actually very simple to start with and begin making money with it in the market. My intention is to make this video short and informative. I have already made a full course video explaining this strategy in extension, including the candlesticks you can combine with it and be winning more in the market. Go check it out. We are the Trading Tribe, and it's a wrap for this video. See you in the next one.